Everybody to the Buckeye Business Builders Monthly Lunch and Learn. I'm Samantha Eiler with Eiler Networking and Computing, and we are your hosts for this event. We will have a recording of this event available on YouTube. I'm going to put in the chat the link for that, and you can find that at a later date. Okay. Our mission at Buckeye Builders is to cultivate a dynamic and supportive business community in Northeast Ohio. We are committed to connecting local professionals, fostering valuable relationships, and providing opportunities for growth and success. Through networking, collaboration, and education, we aim to empower businesses and contribute to the economic vitality of our region. We meet the second and fourth Tuesday from 11:30 to 12:30 at the Northern Ohio Business Center, 5224 Cobblestone Road, Sheffield, Ohio, 44035, which is across the parking lot from Sam's Club. If you would like to attend, please fill out the contact form on our website at bbbng.org. Let us know your name, company name, and what business category you would like to fill. Our presenter today is Emily Dantio, telling us about tax saving strategies to consider before the end of the year. Emily, I'm going to hand it over to you. You can share a little bit about yourself and go from there.
All right, thank you so much. My name is Emily Dantio. I am a CPA and owner of Dantio Grabo Company. We are a firm in Westlake, and we were established in 1946. Our areas of expertise include individual and business tax planning, preparation of returns, small business accounting, including on-site bookkeeping, QuickBooks setup and training, and other services to meet our clients' needs. We pride ourselves in providing exceptional professionalism, responsiveness, and the highest quality of work. So a little bit about me personally. I have been with the company for 7 years. I previously worked for another local CPA firm for about 4 years before coming here. I am a third-generation CPA. My grandpa was actually one of the first partners of this firm back in probably pretty close to when it started, so in the 40s, early 50s. My dad became a partner in the 80s, and I became a partner just this year. So I wanted to go over some tax saving strategies as we're coming close to the end of the year and, last minute tax planning. So first I have to say,
I do not mean to interrupt, but
Sure.
I just wanted to let everybody know, please feel free to, in the chat, ask your questions. And at the end of Emily's speech, we will then go over those questions and we'll go from there. Emily, back to you. I'm so sorry.
Thank you. So I have to first say that I am not offering tax advice here. So the best person to consult is your tax professional who knows the ins and outs of your situation and can help you and advise you on what you can do for your tax saving strategies. First thing I wanted to talk about was maximizing IRA contributions. For 2024, a traditional IRA, you can contribute up to $7,000. If you're over 50 years old, you can also do a $1,000 catch-up contribution for a total of $8,000. Simple retirement accounts, the limit is $16,000, and 401ks is $23,000. Now, the deductibility of traditional IRA contributions depends on meeting certain circumstances. For example, whether or not the taxpayer, and if they're married, their spouse, are covered by retirement plans at work. So a lot of us, if we're W-2 employees, we have, some sort of IRA or retirement plan through our work. So usually those contributions are pre-tax already. But if you don't and you contribute on your own, it's either going to be deductible, partially deductible, or not deductible at all, depending on if you and your spouse are covered by workplace accounts and depending on how much income you have. Another very common strategy is to contribute to HSAs, health savings accounts. Now, these are only available if you have a high deductible health plan, which for 2024, the annual deductible has to be no less than $1,600 for self-only coverage or $3,200 for family coverage. If you have a high deductible health plan, you can contribute to an HSA account. The limits for 2024 are $4,150 for self-only coverage or $8,300 for family coverage. If you're over 55, you can also do an additional $1,000 catch-up contribution. These are either tax deductible, these contributions are tax deductible or pre-tax. Again, if you have the option to contribute to an HSA through your work, it's usually taken out of your pay pre-tax. This is a really great option. I am all for HSAs. So one thing is the interest earned is tax-free and funds can be rolled over year to year. So people are like, oh, I don't have many, health expenses. That's okay. You can still contribute the max and it just rolls over. So at some point, a lot of us are going to have some sort of even a minor health issue that might just cost a little bit more. You have that money in your health savings account and you can use that money for those expenses. Another great option we make our clients aware of is that you can keep rolling over that money. And when you get to Medicare age, you can use those funds for your Medicare premiums. So really, the hope is we all reach Medicare age and we have HSA funds to pay for those premiums that we've just been building over the years if we didn't have to use it all. So we always bring that up to our clients. A lot of them don't necessarily think about putting the full amount in because they don't have many health expenses, but we just make them aware of the benefits of funding that HSA fully and letting those that money grow, and it can be used at a later date. Another strategy that we bring up to our older clients is using your required minimum distributions from your retirement accounts to contribute to charities. So what you can do is you can transfer money directly from your required minimum distribution to a 501c3 charity. The benefit of this is that amount that you contribute to charity reduces the amount of that income, so you're not taxed on it. So let's say you receive $50,000 every year from your retirement, and you always contribute $10,000 to this one charity. What you can do is you can directly transfer that $10,000 to the charity, and instead of being taxed on that $50,000 of income, you're only taxed on the $40,000 of income. So rather than just making a separate contribution and not really having any tax benefit, it's really easy to just transfer from your retirement to a charity and reduce that taxable income. So we have a lot of clients who are very charitable. So there are a number of clients that do take advantage of this. It's also, if you want to look up more about this, it's called a qualified charitable distribution, or QCD. You could transfer up to $105,000 each year. Now, if you itemize your deductions, you can't take another deduction for that charitable contribution. That would be double dipping, which they don't like, but it reduces your taxable income. So that's a huge benefit. Another item that we recommend to a lot of our clients involves what we call bunching your itemized deductions. So everyone receives a standard deduction on their tax return. For 2024, the standard deduction amounts are, for single individuals, it's $14,600. And for married filing joint, it's $29,200. This amount reduces your taxable income. Everyone gets this, okay? But you have the option of itemizing your deductions, which means if your itemized deductions are more than the standard deduction, you'll get a greater deduction from your taxable income. Itemized deductions include taxes up to $10,000. So that's state and local income taxes and real estate taxes. It includes mortgage interest paid and charitable contributions. It does include medical expenses, but unless you have a significant amount of medical out of pocket, or you're in a nursing home or an assisted living, most people don't have enough medical expenses to even count when you're calculating the itemized deductions. So I say, for the most part, it's really taxes, mortgage interest, and charitable contributions. So what we tell people is you can bunch your itemized deductions, meaning you pay more in 1 year and then don't, like you pay more taxes and maybe contribute more money in 1 year, and then the next year you reduce that. What this does, it takes advantage of taking that high standard deduction amount 1 year, and then the year that you have more contributions, you get higher than that standard deduction so that you get a benefit where otherwise you would have only taken the standard deduction. So I'll give an example because it's a little bit confusing if you're not too familiar with it. I'm going to use, let's make it simple and say the standard deduction is $30,000, okay? You can take up to $10,000 of taxes. So let's say a couple has $10,000 worth of taxes and they contribute $20,000 a year to charities. So that's $30,000. Well, in that case, the standard deduction is $30,000. You would just take the $30,000 standard deduction. What we suggest with the item or the bunching is to pay 2 years worth of charitable deductions or charitable contributions in 1 year. So if you can pay $40,000 to charities plus that $10,000 taxes, you have a $50,000 deduction rather than the standard deduction of $30,000. And then the next year, you don't pay any, you don't make any contributions, and you still get that higher standard deduction of $30,000. So by bunching the charitable contributions and in some cases taxes, if you're not above that $10,000 limit, you can take advantage of the high standard deduction right now, and then every other year taking above the standard deduction. In that case, if you only did $10,000 a year, I'm sorry, $20,000 a year to charitable contributions, every year you would have $30,000, which would be the same as the standard deduction. So you wouldn't have any extra benefit. So it's a little bit complicated. Like I said, not the simplest thing to wrap your head around, but it's something we often talk to our clients about. Another great option right now is for Ohio. This again has to do with charitable contributions. So right now, Ohio has a program called the Scholarship Granting Organization, or SGO. It is a system that you can donate to. It's a lot of private schools. For example, like in this area, like St. Joe's, St. Ed's, Ignatius, Magnificat, they're all on the list. These private schools and everything have to apply to be part of this SGO. And then if you donate to those schools through the SGO, you can take a credit on your Ohio tax return up to the lesser of $750 or the total amount donated. So you can find a list of the SGOs on the Ohio Attorney General website. You can just search Ohio SGO and you should be able to find the list there. But for example, I went to St. Joe's for high school. So I donate some money to them. And I can donate through the SGO. That's the key part. You have to do it through the SGO. And if I donate $750, then I will get a $750 credit on my Ohio return. And the credit is a dollar for dollar reduction of tax liability. So it's not a $750 deduction. It doesn't reduce your Ohio taxable income. It's more like you already have $750 paid in towards your tax liability. So it's a really great option, especially if there's a school you went to or your children went to and you always donate to them. It's a great opportunity to put money back into those organizations you already support and get a really great tax credit. So keep that in mind. Not a ton of people are aware of that. It came out a few years ago, so it's a really awesome program right now. I want to discuss a little bit residential energy credits. Most of the common items that we see among our clients are qualified energy efficiency improvements, which is like your exterior windows, doors, skylights. And then the other credit is the residential energy property, which includes energy efficient heating and cooling equipment. So for qualified energy efficient improvements, those are the windows, doors. The improvements must be made to your principal residence, and each improvement type has a different credit allowance. For example, the maximum annual credit available for windows is $600, while doors are eligible for up to $250 per exterior door, with a total of $500 for all exterior doors for the year. For the residential energy property, which is the heating and cooling equipment, the improvements can be made to your residence whether or not it's your principal. So it could be like your second home or anything like that. and the expenditures are eligible for a maximum annual credit of $600. So it's important to, I mean, nowadays, a lot of the windows and doors and equipment that is put into your house is energy efficient. So it's important to make your tax advisor aware that you did these improvements to your houses, so that they can see if you're eligible for these credits. We always send out a questionnaire to our clients, and that's one of the questions. So that way, every client gets asked if they made any improvements to their house, then we can be aware of it and see if they're eligible for these credits. Otherwise, it's not something a lot of people think about when they're preparing their taxes or getting their information together for their tax professional. So just keep in mind if you've done any sort of improvements like that to your home. All right, so this one is a little complicated, but it's a great option. I want to talk about avoiding capital gains tax. So capital gains, long-term capital gains, are taxed at 3 different rates: 0%, 15%, or 20%. And that's based on your income. So the 0% rate for single people is taxable income up to $47,025. For married filing joint, it is $94,050. This is for 2024. So what you can do is, if your taxable income is lower than that threshold, any capital gains up to the threshold will be taxed at 0%. So I have an example I want to read you because it's not the easiest concept, as it happens to be with most tax concepts. They're not very easy. So this example is a married couple. They have income of $50,000. Only one of them is working right now. They have a $50,000 W-2. So they also have 1,000 shares of Disney stock that they inherited many years ago. It was valued at $50 when they got it. Today it sells for $100 a share. So they don't want to use that money. They don't want to get rid of the shares. They want to have them. So what an option is that their income was $50,000 for the year. You add their standard deduction, which for married filing joint is $29,200. That brings you up to the maximum income level that you can have to have 0% tax on capital gains. So in this instance, it would be $50,000 plus that $29,200 standard deduction. So $79,200 is the maximum. That's their taxable income. And they can go up to $123,250 that can be tax-free long-term capital gains. So what they can do is they can sell those 1,000 shares. It's valued now at $100 a share. So that means, let's see. Oh, I'm sorry. It was, it was $100,000, but their basis in that stock was $50 per share. So they have a $50,000 capital gain if they sold those shares. $50,000 plus their income of $79,200 is less, well, actually it's less than the maximum threshold. So they would be able to get $50,000 at a 0 tax rate. You don't have to pay any tax on it because you're under that threshold. In this example, they then had, since the people didn't want to get rid of those stocks, you could just turn around and buy them again so that you still have them, but you still got the benefit of getting $50,000 with no tax, which is amazing. So this is a complicated item. I would recommend, talking to your advisors about this, unless you're like really good with stocks and understanding all this. But it is a good option to have in case you do have stocks that they're very valuable. They've increased in their value, and you have low income. All right. So a couple other items I want to go over. These are more business tax saving strategies. The first one, a lot of our clients come in for year-end tax planning and they say, what can I do to lower my taxes? And we say, well, if there's equipment or something you need to purchase for the business and you just haven't, if you need it, buy the equipment. That will lower your taxable income for the year. Some people do say, oh, I have these items I could buy. I don't really need them right now. In that case, it's up to the client, but we typically our firm is more likely to suggest, if you don't need it, you don't need to buy it right now. You can put that extra money in your pocket, but it's up to the clients. So if you have equipment and you look at the end of the year and you have a nice net income on your business, maybe if you have that equipment you need, you can go ahead and buy it and lower that. So you'll have less taxable income. Another item I want to bring up is mileage reimbursement. So I have several clients who do not take advantage of mileage reimbursement, but it is an excellent option. The reimbursement rate for 2024 is 67 cents per mile. It doesn't sound like much, but it really adds up. We'll know the 2025 rates. It should be released in December. So we should be learning about that in the next month or so. The part that people don't like about doing the mileage reimbursement is that you have to have detailed records in order to support your claim that it is a business expense. So really, the IRS, if they were to audit you, they would want a detailed log, which includes, the date you drove. Where did you go? What was the purpose of that? Was it meeting with a client? Was it a networking meeting? Was it meeting a potential client? So the purpose of the trip. And then the number of miles you drove. So a lot of people are hesitant to do this because it seems like a lot of work. And if you do drive a lot, it is a lot of work, but there are apps out there that you can just turn on when you get in your car and you're going to a business meeting, and then turn off when you're using the car personally. One that several of my clients have used is called Mile IQ. And that is like what I said, you turn it on when you're going to a business event and then turn off when you're using your vehicle personally. And it tracks, the number of miles, the date, and then you would have to just record, who you're meeting, what the purpose was. But you do have to have that to really substantiate that this was a legitimate business expense, because mileage is one of those gray areas that is easy to get away with, not being completely honest with the mileage. But it really adds up over time, that 67 cents per mile. And that can go straight into your pocket from your Schedule C business, and put that money back in your pocket. So I like to bring that up to my clients, especially when they're not utilizing that. One other item I just wanted to bring up that's separate from really tax saving strategies is the rules regarding retirement accounts. So in 2019, a new rule regarding inherited retirement accounts was released, saying that the money had to be withdrawn within 10 years. We didn't have clarification whether the recipients had to take a withdrawal every year, or if they had to just take all of it by the last year, what the details of that were. So we now have clarification. And for most heirs, like children, grandchildren, if the person who died was required to take their required minimum distributions, the RMD, then the recipient also has to take an annual payout beginning the year after death. So they'll have to take out an amount every year and then make sure all the funds are withdrawn by year 10. If the person died before they were required to take the withdrawals, then the heir can take out the money anytime during the 10-year period. These rules don't apply to spouses. So it's just for, like children, grandchildren, other people inheriting. So if you have an inherited retirement account since 2020 and are unsure whether you need to take required annual withdrawals, consult your tax professional. I have a couple clients coming to me now as we're getting close to the year end to do tax planning because they have inherited retirement accounts. And one of the things you want to plan around is if you only have to take a minimum amount each year, you could end up with having a large lump sum that you have to take in year 10 in order to close out that account, which means more taxes that year. So if that's a concern for you, then you might want to consult with a tax advisor and come up with a plan of how much to take out each year so that you don't get hit in year 10. So like I said, I have a couple clients coming to me right now wanting to discuss the tax planning for 2024 and see what their tax liability is going to look like with these withdrawals that they have to make from inherited retirement accounts. So that is all I had for you. I know some of the stuff is very technical and confusing, which is why I say consult your tax professional. They can help you, but at least it gives you a few items to think about and, might ring a bell in your head like, oh, I could contribute more to my HSA, something like that. So does anyone have any questions for me? I don't think I see any in the chat box.
So I have a couple of questions that I
Okay.
have just to add to it.
Mhm.
How can self-employed people lower their taxes before the new year and for next year?
So that would be, taking, if you have, like I mentioned, you have equipment or items that you need to buy, do it before the end of the year. If you have a net income, that'll reduce your net income for the year. Again, if you haven't been taking advantage of the mileage reimbursement, if you even start now and just keep a log for the 2 months remaining of the year of your mileage, you can reimburse yourself for that mileage. That reduces the taxable, the net income of the business, which would reduce the taxable amount on your individual return. So those are a couple of the big ones. Honestly, unfortunately, a lot of people come to us and they say, what can we do? What are some ways to save on taxes? There aren't that many ways right now. Will that change? Possibly. But there aren't many ways to reduce your taxable income. So these are a couple of the common ones we suggest to our clients.
Great, fantastic. Can I use my losses from previous years to offset current gains?
So are you talking
That was
like
for
stocks?
yes.
Yes. So if you have a loss carry forward, you can take up to $3,000 of losses on your return each year. So if you have more than that, they will get carried forward that can offset gains the next several years.
Wonderful, fantastic. Are there any other questions that anybody can think of? What are the most common tax mistakes that you guys see coming to the end of the year?
Oh, we see a lot.
Sorry, was trying to stay away from vague questions, but
I mean, we see a little bit of everything. A lot, I would say, for people who have self-employed income, one big thing that can be missed, and I've seen it several times, usually from self-prepared returns, but I have seen them from paid preparers that they miss this completely, which is shocking. But Ohio has a law right now that you can take $250,000 of your self-employed taxable income, and it's not taxable. So it's huge, especially if that's your only income. It basically wipes out your Ohio income. I have seen, like I said, self-prepared returns and some paid preparers who did not do that calculation. So the people were missing out on that huge reduction of their taxable income for Ohio. So in cases like that, we will discuss it with the client, see what the tax savings is, and discuss with them if it's worthwhile to amend those returns, which is easy enough to do, but it is, obviously we have to charge for that work. So we usually make sure in that case, usually the savings is worth our cost. But we always bring that up to the client and let them know their options and kind of go from there. So that, I would say that's a big one for like self-employed individuals that we see.
fantastic. Okay, are there any tax breaks that we can have for having a home office?
Yes. So if you have a home office, what will happen is you get to take a portion of your home office expenses against your Schedule C business. So it's based on the square footage. So if you have a house, let's just say it's 2,000 square feet total, and your home office is 200 square feet. So that's 10% of the total house is your home office. So you could take 10% of your electricity for the year, your internet, gas, water is not as used because usually you're not using water much in your office, but you can take 10% of your real estate taxes, mortgage interest, any furniture that you buy for that office, all of that would be deductible at that 10%. Now, the law does stipulate that it has to be used 100% for business. So it really has to be an area that's designated for work, and it's not like a common area that you use for other, times also. But yeah, you can definitely take deductions for a home office.
Fantastic. Okay. I'm trying to think of a last and final question. This is one that's a little bit less about business related, but I thought might be a fun one. Are there any tax credits for parents with kids in college?
So you can, yes. So you can, first of all, you can contribute to a Ohio 529 plan. And that can, put money towards your kids' education, and you get a credit on your Ohio return. There are also federal credits like the American Opportunity Credit or the Lifetime Learning Credit, which are available. They are limited or phased out depending on your income threshold. So it depends on whether, if your income is too high, then you probably don't get to the benefits of some of those credits. But it's definitely worth, telling your tax professional about that. Usually if I have clients that have college age students, I ask them, is that student still a dependent of yours? Because it has to be a dependent. And, find out more information if they're within that, under that threshold for their income.
Fantastic. Okay. How do businesses handle employees living in different states?
So it's going to be mostly, obviously for their pay, you have to withhold different state and possibly local taxes. And then on their returns, on the tax return, what you typically do is you figure out the portion of your income and expenses that's allocated to that state, each state. And if it's, if your income is all in Ohio, but you have someone in Pennsylvania working, then there's a calculation that you take, okay, I have this portion of wages that I paid to an employee in Pennsylvania, take that as a portion of the total wages paid, and then a portion of your income gets allocated towards Pennsylvania based on the wages and if you had any income in that state. So it's not a simple calculation, but it's based on like the activity you have in those states, and then a portion is applied to the state, if that makes sense at all.
Absolutely, it does. Yeah. Thank you so much for answering all of the questions that we have.
Oh, yeah.
I think I'm going to kind of wrap it up from here. Thank you so much for speaking and giving us a lot of information, a lot of relevant, great knowledge. And we greatly appreciate you, Emily.
Yeah, thank you for having me.
Of course. So join us next month, and that will be for our December 5th for our next Buckeye Business Builders Lunch and Learn. You will have to check back in with us on our website at bbbng.org to see who our speaker for next month is going to be. That is also where you can register for the next event coming up. Emily, again, thank you so much. I hope you all have a wonderful rest of your day and a great rest of your week.
Thank you.
Have a great day, everybody. Bye-bye.
Bye-bye.